Hello, very good morning to all, and I hope that you guys have a wonderful and restful weekend. Very good morning and welcome to a brand new trading week. I'm Kelvin Wong here again. Today will be Monday, the 5th of May 2025. So before we start today's daily dose of market insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we go straight into today's intraday technical outlook on those broad-based cross asset classes that we cover on a daily basis, that means i.e. the major US dollar pair, the major stock indices, and as well as the two key commodities market, which is gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape over the weekend and as well as during the US session. All right, so let's have a quick look at the major performance of the performance of the major US stock indices as per se. So on Friday, all the four major US stock indices actually ended in the green. So they have so far been up for 9 consecutive sessions, taking into account the performance of the S&P 500. So the S&P 500 on Friday added by 1.47%, the Nasdaq up by 1.6%, the Dow Jones up by 1.4%, and the Russell 2000, the top performer, up by 2.3%. So this intraday movement on last Friday during the US start of the US session, where it actually rallied all the way up and closed near the session high, has been attributed to this optimism of this potential de-escalation of the current US trade tension with China. All right, and we flip to a bullish stance since the start of this week, potentially looking for this short-term up move, all right, in the major US stock indices. But from a technical perspective, we do cautious that there are no clear signs yet that this ongoing rally in the last 2 or 3 weeks or so in the major US stock indices has started to transform into 100% certainty that we are at the start of a new impulsive up move, potentially that may breach the April stage that bullish breakout above that April 2024 high. Okay, to April to the current so-called February or March/March all-time high that is being seen in the major US stock indices. There's no 100% confirmation of that movement yet. So later I'll explain to you all why. All right. So and also in terms of economic data released that supported this intraday spurt up in the major US stock indices was the better than expected non-farm payroll data that was released on last Friday. All right, so on the non-farm payroll data over here, let me immediately go all the way down. Yes, so US non-farm payroll data came in better than expected, 177K jobs added versus 130K jobs expected, all right, by market participants over here. And what's interesting over here is that the prior month of non-farm payroll data released in the month of March has been revised downwards. All right, previously it was at 228K. It has been revised down to 184K. All right, so despite the fact that it came in at 177K jobs added, more than what is market expecting, but going forward over here is that the potential impact on the current US tariffs may not have starts to translate into the job market yet, because this is for the month of April. All right, and we know that it's only at the start of April on Liberation Day, US President Trump has two tier of tariff. One is the base tariff, 10% across the board, which is likely to stay permanently. and the higher reciprocal rate tariff, which she has already instructed a 90-day pause due to potential negotiation with the respective countries over here. So despite the fact that even though we have this optimism of this trade deal de-escalation with China, there will be still a base tariff about minimum 10%, and as well as other sectorial tariffs like 25% depending on automobiles, and up and coming there could be semiconductor chips products that may come in as well, that will start to be much more will stay in line on a permanent basis potentially. So with these higher trade tariffs of a base rate and a sectorial basis coming into play, potentially, right, we may start to see the US job market weaken in the next few months. All right, so market is just looking at this very short-term optimism that's caused the spurt up in the in the so-called major US stock indices on last Friday. And what's interesting over here is that over at last Friday, this spurt up in the major US stock indices was not actually reacted in sync with a bullish movement on the US dollar index. So market participants are also pretty much worried that the US exceptionalism team play has started to fail off because of this haphazard way of the US current administration, the current US administration in implementing its rather complicated tiering system of trade tariffs, not only against China, but against the rest of the world, that potentially could start to see take for that measures coming back into the picture from a medium-term perspective if these trade tariffs were permanently here to stay. And with that, that causes the markets to view very negatively on the US dollar. So if you look at the US dollar performance on last Friday, the dollar strength that was seen at the start of the week has started to thunder downwards. What you could see over here is that the dollar strength starts to thunder downwards, and the dollar is now weakening the most based on the 5-day rolling performance basis as of 5th of May against the Chinese yuan and as well as the Singapore dollar. And even previously, the dollar yen got spiked up due to that dovish hold by BOJ on 1st of May, which I highlighted earlier in last week daily dose. And very interestingly, that spike up didn't have a daily close above the medium-term pivotal resistance of 15450. Later, I will touch again on the intraday technical outlook to highlight the chart. And we flipped to a intraday bearish bias on the dollar yen on last Friday, and the dollar yen actually portrayed that weakness that we highlighted on last Friday. And in today's Asia session, it also attempt to trade lower, as now trading at 14425 with an intraday loss of negative 0.4% as we're speaking right now. So what we could see over here is that there's a desynchronization of things going on in the markets right now. Yes, US major stock indices is anticipating that so-called uh, trade tension with China going to a much more softer scenario. That means we call it tension de-escalation, that is pushing up the US stock market on last Friday. Also rejoicing the very short-term rear view mirror that the labor market is still rosy, but the labor market may turn, the labor market in US may turn sour in the next few months because the US trade tariffs, there are still certain portion of it that's not going to be eliminated totally, right? Which is the base tariff of 10% that US has against the rest of the world, not only in China but other friendlier nations as well, like EU and even in Singapore. And what's interesting, on Friday itself, there could be also tit for tat measures where the US Treasury that has been purchased by the rest of the world in the last 10 over years could be used as a negotiation tool to get whatever party deems that is appropriate in order to strike a more coherent and justifiable trade deal with the US. So we know that since last week, US has been in a so-called US President Trump pride that a lot of countries has started to knock on his door to actually negotiate trade deals. So Japan has really concluded its second trade deal round of trade talks. Okay, not trade deal talks, but things are still not so conclusive yet. So Japan will actually hold the third trade negotiation talk with US somewhere around in the middle of this month. And also we have ongoing trade deal negotiation with South Korea, India, and as well as Taiwan this week. And what we could see over here is that there is this rather conflicting messaging out by key Japanese officials after the conclusion of that second US Japan trade deal negotiation talk that actually concluded last week. Okay, on last week, late last week. All right. So over on Friday, Japan Finance Minister, okay, Kanto stated that U.S. Treasury holdings could be used as a negotiation card in the up and coming third round of US Japan trade deal negotiation talk that is likely to take place in the middle of this month, which is May. So because of this particular statement, that causes the dollar to actually be weak as well in last Friday US session. And with that, we also start to see a very clear bullish reversal candlestick that was formed on last Friday on the 10-year US Treasury yield. So bearing in mind, the 10-year US Treasury yield is a very important benchmark of for global interest rate setting, especially for the longer term. That means US Treasury yield is being deemed globally as a risk-free interest rate, and your corporate loans at longer term, your corporate loans, longer as well as longer term loans, most of them are use the US 10-year Treasury yield as a risk-free rate to price accordingly. Right. So if the US 10-year Treasury yield increases, there could be a risk of higher interest rate costs, not even in US and against the rest of the world. So what you could see over here, because of that statement made by the Japan Finance Minister Kando on Friday, stating that there could be a risk that Japan, if being pushed to a corner by US to actually accept undesirable terms in Japanese context, the Japanese authorities could threaten the US by selling US Treasury holdings. That means the long-term Treasury holdings, that 10-year and above. So that causes the yield to actually spike up. So bear in mind that US Treasury yield move in the different opposite direction with their prices. That means the Japanese official finance minister Kendo threatened to sell U.S. Treasury bonds. The U.S. Treasury bond price will fall and yield price will increase. So that's why that explains why the 10-year U.S. Treasury yield did a bullish reversal after a test at the key 200-day moving average and the key medium-term pivotal support at the 4.15% level, and it has a weekly close because and the daily close last week back above the 20-day and the 50-day moving average again. So indicating that that pullback from 1st of April all the way down to 30th of April may be over, and that could be another round of multi-day to multi-week uprise in the 10-year US Treasury yield. So if this US 10-year Treasury yield keep spiking up higher because of this risk of Japan and even potentially could be China as well, because China is also one of the biggest holder of US Treasury bonds, that potentially may not gel well for the major US stock indices, because higher cost of funding in US as represented by the push up in the 10-year US Treasury yield may potentially trim profit margin in the next quarter US earnings result. All right, so that is something to look out for. So you see a lot of desynchronization that is going on in the market. US stock market is showing signs of optimism that the trade deal, we call it tension between US and China, potentially may ease off, and as well may ease off against the rest of the world. But however, the FX market and the fixed income market is not showing such optimism. Right. So which one were to believe? I believe that the market participants are also as confused as now. So we got to take things one step at a time. Right. So then because of this spike up in the US Treasury yield, I think there's some damage control that's being done by this Japan finance minister on Sunday. All right, over here. Okay, so on Sunday, we are not considering the sale of US Treasury as a means of US Japan negotiation, Kando said in Milan, Italy on Sunday. So there was a bit of damage control in terms of PR. So, but the damage, the cat has already been out of the bag or out of the house. That since he already mentioned it on Friday, and because of the dialing back by him on Sunday is more likely due to some kind of PR damage control, and market participants may start now to actually have an air of suspicious that the Japanese authorities may go on in this path using US Treasury holdings as their negotiation tool in this upcoming US Japan trade deal negotiation talk, the third round to be likely take place in the middle of May this month. All right. And over the weekend, we do see a bit of optimism coming up from the US White House over here. So over at the US White House, Trump actually rules out firing Powell while pushing him to cut rates. So he actually made a media interview on Sunday stating that he likely is to allow Trump Trump likely is to allow Powell to remain till the end of his term in May 2026. All right. But after that, he said that he did mention that he also can replace him in another short period of time. That means he gave a bit of a leeway that potentially he may start to change his stance again. All right, so it's like flipping the button on and off based on the whims of himself, that whether at a certain point in time whether he wants to fire Trump or not before his whether Trump wants to fire Powell, pardon me, before his May 2026 terms end. But over at Sunday, by a media interview done by I think MBS or something like that, that US President Trump only at the moment rule out firing Powell, and things may change because he at the interview he says that Trump said that he can replace him, Powell, in a short period of time. All right, so so we know that things are always very fluid in terms of how US President Trump manages his expectation on certain aspects of the governance of the US Federal Reserve. All right, and also on give me a minute. On the same interview, he also stated that some trade deals may come as soon as this week. All right, another round of optimism again from Trump. So we know that this week might be also pretty much getting a bit of noise from trade deal related news flow that we can't forecast in advance or can't anticipate in advance, and we got to take things as is it when it starts to come out and hit the news wire, and it may create that two-way volatility in the broad-based cross asset classes. So something to be mindful this week as well, because it could potentially price movement could swing both ways and influenced by this trade deal negotiation talks outcome, as right now portrayed by US President Trump over an interview on Sunday, saying that some trade deals may be concluded as soon as this week. All right. And what's interesting over here is, let me share with you another news flow. All right. And this is not so optimistic. It's more of a new sectorial or product-based tariff that Trump has started to unleash as well. On Friday, on over the weekend interview, he said he plans to actually, okay, that you guys can see a screen. Okay, let me make sure that the screen is being shown. Seems to me that the screen has frozen. Okay, let me adjust again. Sorry about that. Okay, so I hope that you guys can see the screen. Okay, should be able to see it right now. Yeah, this is the screen. Okay, so over the weekend in the same interview, US President Trump, in his planning stage right now, he plans to introduce 100% tariffs on foreign firms. That means, i.e., any firms that are actually foreign firms that are movies, any foreign production movies, films, may starts to have this 100% trade tariffs imposed by US. All right, so this is another sectorial based tariff. That means, i.e., is not country based, but rather product base, something like the 25% automobiles tariff that was introduced last month, and the upcoming, I think 20% or 25% plus semiconductor tariffs as well, that's going to be implemented soon. So Trump's plans another sectorial product-based tariff, and this time around he's much more aggressive by by putting a print of 100%, okay, on foreign movies or foreign production movies or films heading into US. So that actually is not saying that Trump will back down on his trade war or trade tariffs with the rest of the world. So as and when, yes, despite that this ongoing negotiation of trade deals to reduce the reciprocal, the higher reciprocal rates that he introduced on Liberation Day, that may reduce, but that could be offset by increasing tariffs or having new tariffs on sector-based, sectorial and product-based products, regardless of where the products or services come from. So net overall, we may start to face higher costs of goods and services going forward. All right, so that shouldn't be a positive scenario for overall global economic growth in the medium term to long term. All right, and also on Australia, election was concluded, and the current incumbent came back in victory, and he has the current Labour Party has the biggest amount of percentage of seats since World War II, and that I think that has more or less been really priced into the market. So we look at the performance of the ASX 200 that was very bullish in the last week or so ahead of the Australia we call it federal election. But however, we start to see profit taking on the intraday basis, where the ASX 200 is down by negative 0.8%. Then thereafter, I'll touch on more about the Aussie dollar. So the Aussie dollar rallied in today's Asia session, going above that 0.64 psychological level, and even it actually pierced above that as well. That actually came in line, more in line of a broad-based dollar weakness. So that'll touch on the intraday technical outlook on the Aussie dollar. And today, two key major Asia market is closed for public holiday, Japan and Hong Kong, and as well as China. So that's why we see a bit of lesser movement during the Asia session as we are speaking right now because of the closure of this major Asia financial center. Japan today is closed for public holiday. Hong Kong is closed for public holiday as well, and China is also closed for a public holiday, and they will resume trading tomorrow. All right. And one more particular news flow that actually is impact the oil market over here. So oil in today's Asia session actually continues its weakness. All right. Still recall on last Friday, we do have a potential corrective rebound scenario that may take place in WTI crude oil price, which is West Texas crude oil in our platform. That corrective rebound, that minor corrective rebound scenario view is getting negated, okay, over here. So later I'll touch on the latest technical outlook on the oil for today because of that steep gap down that is being seen in today's Asia session, driven by the fact that OPEC Plus agreed on Saturday. OPEC Plus agreed to have another bumper output increase. That means they continue to increase their supply or continue to increase their production into the oil market, despite the fact that external global demand environment is still lackluster over here. So the reason why they decide to actually go ahead with this output increase, where they conclude on Saturday, is to actually punish overproducing members, including Kazakhstan, in a strategy shift that have already sent prices plunging. So what OPEC Plus members agree is that they decided to hike more than 400k barrels a day from June onwards. All right, additional, that means more than 400 barrels a day, and that was also a similar increase announced earlier last month. So, i.e., there will be more supply of oil coming into the market, and in light of this global demand environment that still remains lackluster, that caused us oil prices to plunge in today's Asia session by I think 4% or so, right? 4 to 5%. Okay, and what's interesting over here is that this movement of OPEC plus, to my own personal opinion, doesn't this current we call it aggressive stance by OPEC plus to push ahead their increase of production doesn't seems to be a rational economic decision making, and potentially it may be much more political instead. Why? Because the production hike that was announced on Saturday just came ahead of a scheduled meeting between in the Middle East region by Trump. So US President Trump is scheduled to travel to Middle East later this month in May. And prior to that, before his travel to Middle East this month, he keep on urging OPEC Plus or pressured OPEC Plus to booster production and bring down energy prices in the US. So do not forget, Trump pledge in his election campaign last year was to actually lower energy prices in the US by looking to actually lower down oil prices. So that's why potentially, right, the last Saturday production hike and much more aggressive production hike announced by OPEC Plus is more due to political reason rather than economic reason. But we still got to respect the price action of the WTI price as the latest price action continue to show on the chart and dictate the short-term to medium-term sentiment of it. So without touch on the intraday technical outlook on the West Texas crude oil. So with that, now let us now focus our attention to the second segment of today's daily dose of market insights, will be the intraday technical outlook on those broad-based cross asset classes, starting with the FX market. So as usual, let me expand my screen so that you guys could have a better view of the charts. Right, so FX market, the major US dollar pair that we cover on a daily basis. Let us start with the euro dollar. So the euro dollar continues to shape that minor recovery after the retest of the 200, after the retest of on its 20-day moving average on Thursday. All right, and on Friday, it managed to survive it despite the push down that was actually seen exposed non-farm payroll data. And today is also attempting to stage that recovery that was inflicted during the after the release of the rosy non-farm payroll data. So as we are speaking, the euro dollar is up by 0.3% against the US dollar. So with that, no change for sure. The 20-day moving average is actually acting as a key pivotal support, which is confluencing our graphical short-term pivotal support level that we highlighted on Friday as well, 112.70 / 112.30. The RSI continues to print out higher low and continue to be held above this parallel ascending trend line above a 50 level mark, hasn't hit the overbought region yet, so indicating there's still potential bullish momentum that may see a further uptick in the price action on euro dollar as we head into the European session today. So with that, no change, still maintaining our intraday bullish bias on the euro dollar using 1.1270 1.1230 as my short-term pivotal support level, as my short-term pivotal support level or support zone. Two key intermediate resistance level to watch for today will be 114.25 followed by 114.80. Only an hourly close below a 1.1230 short-term pivotal support level may damage today's intraday bullish bias view to kickstart another round of minor corrective decline sequence, exposing 1.12, 1.1120, 1.1050, which is also the former major long-term circular descending channel resistance, now turns into a significant pullback support at the 1.1120, 1.1050 level. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar also continues to actually trade sideways on last Friday, but the hourly RSI continues to shape a series of higher low and now is actually still continues to hold above this parallel ascending trend line, hasn't hit the overbought region yet. So that also indicate that potentially some form of bullish momentum still remains intact on the sterling dollar. So no change, still looking at the 132.50, 132.05 short-term pivotal support zone as my basis to maintain the potential intraday trend bullish bias for today. Price action got to break out fast from the first intermediate resistance zone for today at 133. First intermediate resistance level for today, 133.40, which is very close to the minus swing high of 1st of May and last Friday minus swing high area as well, where price action sold off after the release of the non-farm payroll data over here, and also in line with this current minor descending trend line that kept prices from going up since the high of 29th of April. So above 133.40 may potentially expose the next intermediate resistance for today on the intraday basis at this minor swing high area of 29th of April and 30th of April at 134.20. Let me put it in writing, 1.34. Okay, 1 second. It's hang for a while. Let me see. Okay, good. Just up 1.3420. Okay, only an hourly close and a breakdown below 132.05 short-term pivotal support level, which also correspond to the rising 20-day moving average, that will invalidate today's intraday trend bullish bias to kickstart another round of minor corrective decline sequence, exposing the next near-term support level at 131.20. A breakdown below 131.20 may see a deeper drop towards 1.2990, which correspond to the rising 50-day moving average. So still no change, still maintaining that potential trend bullish bias on the intraday basis, with the key short-term pivotal support zone at 132.50/32.05, and to increase the odds of today's potential bullish trend bias, the sterling dollar got to have a breakout above its intermediate resistance at 133.40. So that's for the sterling dollar. Right, next up will be the Australia dollar, the Aussie dollar. So the Aussie dollar right now has started to did a push back up against the 64 figure level. So roughly more moving in line with the broad-based dollar weakness that's been seen in late last Friday, spilling over in today's early Asia session as we are speaking. So what we could see over here is that it's now showing hesitance against at the 200-day moving average, which is acting as a resistance level at 64.70. So 64.70 was our short-term pivotal resistance on last Friday. And what's interesting is price action shaped a higher high, all right, a higher high over here. But so let me put it, it's sloping upwards. Okay, higher high, but the hourly RSI is shaping a lower high. Okay, moving in contrast with the price movement of the price action that is showing that uptick right now. So this is what I call a bearish divergence after hitting the overbought level on Friday. So with this kind of mixed element that's being seen, number one, not so rosy positive momentum on the Aussie dollar, but on the external basis, where we start to see dollar's weakness in the major US in the major currency pair like the euro dollar and the sterling dollar, and later I'll share with you the dollar yen as well, where we're seeing this dollar weakness. I'm not so we call it have a much confidence to maintain that intraday bearish bias that we have on last Friday, despite the fact that it hasn't broken above the short-term pivotal resistance that we have on that we highlighted on last Friday, which is the 64.70, that coincide with the key 200-day moving average. So with such lackluster individual hourly RSI momentum that is being depicted on the Aussie dollar, we will flip to a intraday neutrality stance for today. So neutral between 64.70 and 64.15. Only a breakdown in the hourly close below 64.15, then that will reinstate that intraday bearish tone to expose the next near-term support zone at 63.40/63.35, which correspond to the rising 20-day moving average as well. So that's for the Aussie dollar. Due to the mixed element, after taking into account of the ongoing weakness that is being seen in the US dollar against other major currency, we will flip to a neutrality stance instead on the Aussie dollar for today between 64.70 and 64.15. 15. All right. So now next up will be the dollar yen. So like I mentioned, dollar yen, despite this is the push up on Thursday due to that BOJ advocating that dovish hold, but it can't break above, it can't have a daily close above 145.50, which is our medium term pivotal resistance level, and that also coincide with the former major ascending trendline support from the low of 16th of Jan 2023 now turns into a significant pullback resistance as well, and we have a bearish reaction of it on last Friday, almost hit the 20-day moving average. That was our short-term support level that we highlighted on Friday when we have a intraday trend bearish bias on the dollar yen. And as we are speaking right now in today's Asia session, there's a negative follow through by having a gap down at the opening, down by negative 0.5%. And also last Friday price action on the US dollar, on the dollar yen, it formed a bearish hanging man after a retest at the 145.50 medium term pivotal resistance. And so what we could see is that technically the price action on the dollar yen seems to be indicating that the rally from the low of 22nd of April all the way up to the high of 1st of May, that may have already ended. So this is a corrective rally, and the negative price action on last Friday and today's negative price action follow through after that appearance of that bearish reversal candlestick pattern, which is a daily hanging man, indicating that the impulsive downward sequence that has been in place since January 2025 may resume. And for sure, to confirm that continuation of this impulsive downward sequence, price action got to break down below the 142 figure level, which is this critical swing low area of 28th of April that actually kickstarted that 3 days of swift up move. All right, so a breakdown below 142 figure level will increase the odds that the multi-day to multi-week impulsive downward sequence on the dollar yen may have resumed after Friday bearish reversal price action candlestick that's being seen right at the 145.50 medium term pivotal resistance. So that's the daily chart of the dollar yen. So fundamental reason why is actually due to that potential so-called selling off of US Treasury bonds, as mentioned potentially by key Japanese officials at the start of my today's daily dose. All right, so I don't want to go that in greater detail again. Now let us take a look at the hourly chart to actually highlight the key levels to watch out for today on the intraday basis. So on last Friday, we do have a bearish bias. Bearish bias hit the support level at the 144 figure level, which is the 20-day moving average, before staging a bounce. Then after that, the bounce can't maintain that follow through, and price action starts to inch down again back in today's Asia session. So with that, last Friday we have a short-term pivotal resistance level at the 14610. So for today, the pivotal on the intraday basis, today's short-term pivotal resistance will be at 145.50 over here. So if we do the Fibo retracement of last Friday's sell-off, that is 76.4 Fibo retracement. All right, so using 145.50 as my short-term pivotal resistance for today, we will maintain that intraday trend bearish bias. A breakdown below the intermediate support level at 144 figure that managed to survive on last Friday may expose further weakness towards the next intermediate support at 14325, which is the confluencing, which is also the minor ascending channel support drawn from the low of 22nd of April. A breakdown below 14325 may see the critical support level at 142 figure next. However, if price action starts to shape a bullish breakout and the hourly close above 14550. Today's intraday trend bearish bias will be jeopardized to see a squeeze up to retest 14610. A breakout above 14610 may see the extension of this ongoing counter trend mean reversion rebound sequence extending towards the upside to revisit 14705, pardon me, 14705, which correspond to the 50-day moving average. So that's for dollar yen, still maintaining the intraday trend bearish bias for today with an adjusted short-term pivotal resistance at 14550. All right, so that sum up the intraday technical outlook on the major FX pair. So now let us proceed to the intraday technical outlook on the major stock indices. So we know that the Hong Kong stock market is closed for a public holiday today, and last Friday we do have a bullish bias, and the bullish bias almost hit the 50-day moving average, which is our resistance zone that we highlighted on last Friday in our bullish bias stance, which is 22,790/990. So given the fact that it's closed for a public holiday today, there will be likely to be as much movement for today on the Hong Kong 33 representing the Hang Seng Index. So with that, we will flip to a neutrality stance for today, neutral between two levels to watch. 22,790/990, and the lower limit of that neutrality zone for today will be 22,110. All right, which is the former descending trend line resistance now turns into a pullback support, and the former minor swing high area of 30th of April and 28th of April. So flipping to a neutrality stance for today on the Hong Kong 33, given lower liquidity in the futures market, given in the overseas futures market, given the fact that the local cash market is closed for a public holiday for today. Right, pardon me for my tongue twisting. Onwards towards the Nikkei 225 representing the Japan 225. So despite the fact that the Japan 225, the local cash market is closed for a public holiday today, when it comes to the European session, Globex, which is the US CME futures exchange, once the liquidity starts to kickstart in the European session, the Japan 225 may start to see an increase in liquidity once the European session open for today. All right, so with that, still recall that on last Friday, we flipped to a intraday bearish bias because the rally that's being seen on the Japan 225 is coming very close to a significant pivotal resistance level, which is 37,380. Former minor swing low area of 7th of March and 21st of March now turns into a critical pullback resistance level. And given the fact that the hourly RSI continues to trace a series of lower high, indicating the lack of upside momentum. So with that, still no change, watching the 37,380 as my short-term pivotal resistance level to maintain the intraday trend bearish bias on the Japan 225. First support level to watch will be at 36,200, which confluence with the rising minor ascending trend line from the low of 7th of April and as well as the 50-day moving average. A breakdown below 36,200 may trigger further weakness on the intraday basis to expose the next near-term support level at 35,470. Only an hourly close above 37,380 and the breakout above it will jeopardize today's intraday trend bearish bias to see a further squeeze up to retest the 200-day moving average and as well as the medium-term descending trend line resistance from the high of 31st of Jan, both of them confluencing at almost the same resistance level at 38,135. So that's for the Nikkei 225, or i.e. the Japan 225, still maintaining the intraday trend bearish bias using 37,380 as my short-term pivotal resistance level. Next up will be the Germany 30 representing the German DAX. So the German DAX or the Germany 30 hit our resistance level on last Friday, where we do have a bullish trend bias at 32,230, and that is also the upper limit of this minor ascending channel that I drew from the low of 11th of April, and that also confluence with the 0.618 Fibo extension as well over here. So with that, there could be a sign that it may start to do a minor pullback scenario in today's session over here once the European session starts. So I'll be using instead of using 23,230, which is the swing high on last Friday, just in case of any whipsaw, I use a slightly higher pivotal resistance level, which is 23,480, and this 23,480 is also the current all-time high area of 7th of March and 18th of March. All right, at 23,480. So as long as this 23,480 short-term pivotal resistance that we have for today doesn't break up on the upside, we will flip to an intraday trend bearish bias for a potential minor pullback scenario that may unfold on the Germany 30 within its minor ascending channel. Lower limit will be at 22,600, which confluence with the lower limit of this minor ascending channel. A breakdown below 22,600 may expose further minor weakness towards 22,320, which also confluence with the 50-day moving average that is a similar minor swing low area at 22nd of April and 28th of April, all confluencing at the next near-term support level of 22,320. However, if price action starts to shape a bullish breakout and hourly close above 23,480, then today's intraday trend bearish bias will be invalidated to see the continuation of the bullish upmove sequence, surging into new fresh all-time high with the next resistance coming in at 23,920. That's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 almost hit our resistance level, which is 41,470, 41,740, which is also the 50-day moving average as well. And you start to see the hourly RSI starting to actually be kept by this parallel resistance as well. Right, so with that, there's some form of lackluster momentum that has started to take shape on the US Wall Street 30. We will now flip to a intraday trend bearish bias using 41,470, 41,740 as my short-term pivotal resistance level. First support zone to watch will be 40,690 / 430, congestion area of 14th of April and 2nd of May, and also confluence with the minor ascending trend line that I drew from the low of 22nd of April. Only a breakdown below 40,430 may expose a deeper intraday drop to retest the 20-day moving average, also confluencing with the next graphical support at 39,720, which is defined by the minor swing low of 25th of April and 30th of April. Only a push up and a bullish breakout with a daily hourly close above 41,740 that would invalidate today's intraday trend bearish bias to kickstart the continuation of that recovery towards the medium-term pivotal resistance zone at 42,080 / 42,400, which also confluence with the 200-day moving average as well. So that's for the US Wall Street 30, flipping to an intraday trend bearish bias stance using 41,470 / 41,740 as my short-term pivotal resistance zone. Next up will be our Nasdaq 100. So the Nasdaq 100, we do have a bullish bias on last Friday, looking for the resistance level at our pivotal resistance zone at 20,250 / 20,390. That almost has already been met, which is the 200-day moving average. And do not forget, on last Friday, I highlight that the second leg of the rebound has started to transverse into a bearish ascending wedge formation. So this is a bearish ascending wedge formation as highlighted in purple. That means we start to see the higher high has a lower slope, or we call it a lower gradient as compared to the gradient of the higher low. So with that lower gradient on the higher high, this represents weakness. Why? Because it seems to us that the rate of change has already started to slow down as well as price action continues to move upwards towards the 200-day moving average. All right, so with that, since and also the hourly RSI has started to trace out a bearish divergence as well by flashing similar high at the overbought level, whereas price action hit the upper limit of the ascending wedge, bearish ascending wedge configuration on last Friday by shaping the higher high. So with this lack of upside momentum condition that is being transpired in the price, the current short-term intraday price action on the US Nasdaq 100, right below the key medium-term pivotal resistance zone, and as well as the 200-day moving average, we are now potentially may see a tipping point of the Nasdaq 100 where it may start to shape a bearish reversal sequence. So with that, using 20,250 / 20,390 pivotal resistance zone for today, I will flip to a intraday trend bearish bias. First support level to watch will be 19,600. So 19,600 is also the lower limit of this bearish ascending wedge support level that I drew from the low of 22nd of April. A breakdown below 19,600 may expose further weakness on the intraday basis towards the next near-term support level at 19,020 slash 18,720, which is the 20-day moving average, acting as a support level, and as well as the minor ascending trend line support that I drew from the low of 7th of April. So if you start to see a breakdown below 18,770, we saw breaking down the 20-day moving average. So that has an increased odds, stating that the rebound in the last 4 weeks is more like a dead cat bounce, and price action may resume the multi-week impulsive downmove sequence again on the Nasdaq 100. So something to look out for as the days goes ahead this week. All right, so that's also sum up the intraday technical outlook on the major stock indices. So now let us now turn our attention to the commodities market, starting with gold XAU slash USD. So gold XAU slash USD, last Friday we used this 3194 slash 3162 short-term pivotal support zone to maintain a potential short-term recovery on gold XAU slash USD. So that recovery kind of take shape, but it hasn't hit our first resistance level yet at 3,315. The hourly RSI looks quite promising as well in terms of positive momentum observation, because on last Friday we start to see a pullback in the RSI. The RSI managed to shape a bounce right above the former apparel ascending apparel former descending resistance, now turns into a pullback support and is still hovering above the 50 level mark and hasn't 50 level mark hasn't hit the overbought region yet, so indicating there could be still some form of intraday bullish momentum in today's session. So with that, still no change, still watching the 3194 slash 3162 short-term pivotal support zone to maintain that intraday trend bullish bias for a potential recovery scenario on gold XAU slash USD. First resistance to watch still remains unchanged at 3115. Only above 3115 may expose 3370 next in the first step. However, if price action starts to break down below 3162, today's intraday trend bullish bias will be invalidated to actually see a deeper slide to expose the next near-term support zone at 3086, 3055, which confluence with the rising 50-day moving average, and as well as the medium-term ascending trend line from the low of 31st of December 2024 low. All right, so that's for gold XAU slash USD. Lastly will be the West Texas crude oil. So West Texas crude oil, on last Friday we attempt to turn bullish for a potential mean reversion minor counter trend rebound heading upwards towards the 62.39 level, which is the 50-day moving average. But due to today's lackluster price movement by this gap down in today's Asia session, where oil prices trading down by negative 4% as we are speaking, due to that rather aggressive production hike stance by OPEC Plus over the weekend, we will now have no conviction that WTI or West Texas crude oil may shape that corrective rebound to retest that 20-day moving average within its medium-term downtrend phase. So that could be the start of another impulsive downmove sequence. So given that the hourly RSI is already hit the oversold level, there could be a bit of minor bounce to take shape during the European session opens, when the European session opens, to cover that gap down resistance, which is at 58.40. So that's our first resistance level to watch. So using 60.35 as my pivotal resistance for today, that's actually in line with last Friday lower swing high area at 60.35. So 60.35 short-term pivotal resistance level will flip to a intraday trend bearish bias for today on West Texas oil below 55.50, which is the minor swing low of 9th of April, may expose the next resistance zone, next support zone, pardon me, at 54.40 slash 53.60, which is the 0.76 Fibo extension level, taking into account of this ongoing minor downtrend. that is in place since 23rd of April. A breakdown below 53.60 may expose 51.60, which is the one-time Fibo extension from the similar ongoing start of the ongoing minor downtrend that is still in place since 23rd of April high. Only a push up and a breakout and the hourly close above 60.35 will invalidate today's intraday trend bearish bias to see the start of that minor corrective rebound sequence, exposing the next near-term resistance level at 62.35 followed by 63.88. So given today's rather negative price action on West Texas oil, we have no conviction that the West Texas oil may shape that mean reversion rebound as expected on last Friday. So with that, we flip to a intraday trend bearish bias using 60.35 as my short-term pivotal resistance for today. So that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today will be Friday, for with Monday. So Monday will be a rather quiet session in the European session. The action only kickstarts on 10 p.m. Singapore time, where is the all important ISM services PMI data, where market participants will be scrutinizing the health of the services sector in the US economy that contributed to 3/4 of US growth. Previous month it start to show 50.8, which is hovering at around the 50 level mark that is still expanding. Anything that's below 50 is showing signs of contraction. So market participant is expecting a slight weakness towards 50.6. All right, over here. And also market will be looking at the ISM services input prices. So that actually represent the cost of business in the services industry. So so far prices has been very high, rising at 60.9. Forecast by Trading Economics is expected to go higher at 61.2. So that is 10 p.m. Singapore time today. And thereafter, that will be a rather quiet session. So only one key economic data to look out for today, which is the ISM Services PMI out at 10 p.m. Singapore time. So with that, that concludes today's Daily Dose of Market Insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you very much.